All right. Well, good. Well, we'll get started because we are at noon and we want to be efficient and we want to welcome you all. Thank you so much for joining us for Avis & Young's third quarter State of the Market. I'm James Nelson. I'm principal and head of Tri-State Investment Sales. Thrilled to have with us today several of our team members, Marisha Clinton, who is our Senior Director of Research for the Tri-State, Justin Piasecki, who is our Principal of Debt, Joint Venture, Structured Capital, and Loan Sale Group, and Keith Caggiano, who is our Principal in our Office Leasing Group with a specialization not only in Manhattan, but Brooklyn as well. So welcome, everyone. Thank you so much for joining. And I'm reporting to you from our new office at 530 Fifth Avenue. We are still doing a shift, and so that's why Marisha, Justin, and Keith are dialing in remotely. Otherwise, we'd love to all be here, together in the same room, but still observing safe protocol. But it has been fantastic to be back in the office, and I think when we're here, we all realize what we've been missing. So we're doing everything possible to get things moving once again. So. We're going to take you through a state of the market for the third quarter. We're going to be talking to you about the investment sale market here. And then Marisha is going to be taking us through office leasing, the stats. And then Keith Caggiano is going to be helping us read the tea leaves. And then Justin is going to be taking us out with commentary on the debt market. Which I think is probably, if we want to leave this on the most positive note, I think what's going on in his world will hopefully get you all excited to jump in and start investing. So with no further ado, Matt, let's go ahead and we'll jump into the first slide. Okay. And I'm going to go ahead and minimize this so I can see this. Okay, perfect. So for the third quarter of 2020, the total dollar volume for New York City, and again, we're talking about all investment sales, which are over $5 million, with the exception of retail. So we track the four major food groups: multifamily, office, retail, development. So hotels are not included, nor are single families. But the sales for the third quarter throughout New York City totaled $1.9 billion. Which was a 67% decrease over last year. Right now, we are tracking for $13.3 billion in sales for the whole year, which you can see is significantly off the 10-year average of $36 billion or the peak in 2015 of $68 billion. Now, by looking at the top, you will see that Brooklyn actually fared the best in the sense that in the third quarter, they only had a 56% drop off only, right? When you compare this to the third quarter of 2019, which we think is kind of in a more normalized environment to draw the best conclusions. Manhattan dropped 74% with 1.1 billion of the sales. Queens down 70% with 351 million. The Bronx with 171 million with a 66% drop, and Upper Manhattan with an 83% drop. Now, by the way, I do want to invite you all throughout this presentation. If you want to ask questions in the Q&A, I want this to be a conversation. So feel free, if there's anything you want to ask about, we can certainly address them. And certainly we can do that throughout for the rest of the presentations. So we'll go ahead and move forward. Okay, so as far as the number of sales throughout New York City, this drop off does not look as severe. But still pretty significant overall, a 54% drop with 77 sales throughout all of New York City. If you annualize that, we'd be at 4 and 11, which is pretty far off, less than half the 10-year average of 1,029 trades per year. But I always find it remarkable in a city with over 150,000 properties, even in the peak of the market, there was only 1,600 trades. So there's still, if you're an active investor, and many of you might be frustrated, and we're going to talk about that a little bit later, while maybe you haven't been seeing inventory, a lot of the product has come off the market, and so you don't see a lot of sales opportunities. Now, Manhattan, again, only 21 sales. We're going to talk about that in a little bit. Brooklyn with 17, Queens with 16, Bronx with 15, and Upper Manhattan with 5. So now as we dive into the Manhattan sales, there was 1.1 billion in sales across all asset classes. Over a third of that coming from office. This was Manhattan had a more significant decline than the boroughs. Only 21 sales, about 64% decline in the numbers there. Multifamily, again, with the most trades. Now, if you go to the next slide, you're going to see year over year what this sales and dollar volume, how this compares. And you see the 10-year average, the average dollar volume per year is usually right around $30 billion. The number of sales on average at closer to 550. So clearly at 2020, if you look at how this year is shaping up, we're going to be back down to levels of 2009, where we also saw very few trades. And I think it's fair to say, actually before we jump to the next slide, that I have drawn comparisons, if you've read my white papers and reports on the second quarter as well, to 2009, when this is a market when there has been very few sellers. We see a lot of the owners who are transacting right now, certainly in the second quarter, are mostly the estates, the partnership disputes, the distress, really the must sells. And now, and I think that certainly carried on into the third quarter, because I always like to remind people that these sales reports, these are really rear view indicators. So when we say that sales volume is still way down right now, we're talking about how activity was really 3 to 6 months ago when these deals were being negotiated and signed. Because by the time they sign, there's a 60 to 90 day close. By the time they are reported, it takes some time to catch up. So what I will say is that the good news is that in the last 2 months, our team, the Tri-State Investment Sales Group, has picked up 20 new listings, which typically we're bringing on 5 to 6 new listings a month. So we have seen a surge in activity, which is great, because again, for those of you looking to buy, you're probably saying, where are all the opportunities? And finally, we are seeing new product come online. Interestingly, half of these new listings have come from owners who have owned properties for over 20 years and are saying, you know what, I've been through enough cycles. I don't know if I have another one in me. It'll be great to hear what the panel has to say, but I think we all can agree this is not something that's going to correct itself in a matter of months. This is going to take some time. And so, you know, the advantage of those of you who are looking to buy is if you're dealing with a long-term owner, typically they have a very low basis and can afford to transact into the market. Okay, so next slide, let's talk about what's going on in the asset classes. So multifamily, only 9 sales, average cap rate 5%. Look at that price per foot at $550 a foot. We are starting to see sales in Manhattan that are getting close to or below replacement cost. Even if you felt, and I believe that land prices in Manhattan are still, for good quality land in the, around $500 a foot, certainly where there's a condo execution. Rentals, typically buyers are looking for $350, $400 a foot. So even if you're buying land for $350 a foot, it still costs, the better part of $400 or $500 a foot to build it. So at this point, there's opportunities in Manhattan that are below replacement cost. If you look at where pricing is compared to the past, I mean, looking in 2016, their cap rates were around 3.5%. And we've seen some pretty significant cap rate expansion coming up to 5%. The price per square foot on average year to date has been at $742 a foot, well off the peak at $1,127 a foot. So certainly some opportunities here. Looking at the 10-year trends, I mean, going back in 2015, that was the year that Stuytown sold over 12 billion in sales, very little sales activity. And this is also coming on the on the aftermath of the rent reform that took place in 2015. Last year. when the rent reform took place, and many of those stabilized units, or all those stabilized units for that matter, became effectively permanent. So we've been battling first with that and now with COVID. But we'll look at some of the sales that took place as a result. On the next page, you can see that 400 East 58th Street, this was a $62 million sale purchased by A&E Real Estate from SL Green. Out of the 126 residential units, 69 were fair market, that was 55%, 57 were rent regulated. The buyer intends to do a renovation and do a value add. This went off at a 5 cap and $443 a foot. Amazing that you'd see an elevated building trade for that kind of price point where over half the units are fair market. 180 West 81st Street, meanwhile, private buyer and seller. This traded at a higher price per foot at $7 to $88 a foot, a 5.8 cap. This is a 5-story mixed-use elevator building with 3 retail spaces with 1 vacancy and 12 residential units, of which the majority were fair market. This property was originally asking $22 million, so this was a 23% discount. Lastly, 94 St. Mark's Place, and I think this was a great sale, all things considered, at $8.5 million, $944 a foot, a 4.7 cap. And this was in contract pre-COVID. It's still closed. It's got 7 apartments, 6 of those almost all being fair market, and it's above a theater and a tattoo parlor, which has been closed down. So, one of the first questions we're now asking when we're valuing properties, and certainly when you all are looking to buy, is, what are collections? And for many of the fair market buildings, the collections now, vacancy rate can be, 20% in some cases. Collections, at that, hovering around that 80%, and retail, significantly less. So, not unusual on that St. Mark's trade that the retailers would either be paying substantially reduced rent or no rent. So we'll go to the next slide. Development sales, only 6 trades for a total of 250,000 feet of buildable, average at 483 a foot in the quarter. That's 490 year to date, down from the peak at 680 in 2016. Go to the next page. You can see that, yes, back in 2015, there was over 10 billion in sales, almost 200 sales on the year. This year, we are below 50. Okay, we'll look at the next slide. So 155 to 66 Bowery, this was actually a ground lease. So I guess they reported for tax reasons a $50 million transaction, but this was a ground rent. And this was purchased, or the lease was signed by REEC, and this included 7 adjacent parcels in Nolita, and the ground lessee plans to build a Class A office building on the site. The next development site at 150 East 91st Street. This was 45,000 feet of buildable. It sold for $654 a foot. This was a user deal in that Redeemer Presbyterian bought the property. They're going to build a cultural space, meeting rooms, and a sanctuary. Lastly, 428 to 32 West 19th Street for $18.5 million, 446 a buildable, purchased by Ambow Enterprises, active boutique developer. Includes 2 adjacent buildings on 19th Street between 9th and 10th Avenue, purchased from a long-term owner. So even that purchase at $450 a buildable, we sold a site on this block about 5 years ago in the 700s of buildable. So you can start seeing, the types of opportunities that are now presenting themselves in the marketplace. Retail. Okay, so here, no surprise. Big adjustment in pricing. I'm not even going to talk about, the averages in third quarter because there was only 1 sale in Manhattan, a small one at 1.5 million, but cap rates are now expanding close to 5.5%. Average price per foot year to date is sub 1,600 a foot, less than half of what it was back in 2015. Back in 2014 and 2015, you saw that there was almost 8-10 times the transactional volume that was taking place. So not too dissimilar from what we've heard so far. The only retail sale we have is a retail condo at 152 Franklin for $1.5 million. And the property was bought out of bankruptcy. There was a former day spa there. Okay, so next we will go to office. Only one sale technically here at $840 a foot, average cap rate at 4.5, $900 a foot year to date. So we'll take a look at what sale that was on the next page. Well, I'm sorry, you see, again, you're getting used to these figures of, much more sales volume over the last few years. So no surprise that again, these numbers are off the peak. So as far as the two meaningful sales that took place the last quarter, and interestingly say, between these two sales, this is 750 million of the 1.1 billion that traded. So if it were not for these two sales, I think the third quarter numbers would have looked a lot different. But 1375 Broadway sold for 435 million, 847 a foot, a 4.8 cap. Buyer was Savannah, seller was Westbrook. At the time of the sale, the property was 100% leased at below market rents. The building's largest tenant, Anshin, Block and Anshin, the accounting firm, occupied 117,000 feet over 7 floors and has their upcoming lease expiring in 2023. This is the second time in recent history Savannah has owned this asset. So they sold it to Westbrook in May of 2015 for 310 million, and now they are buying it back for 435 million. And I think what we're seeing here, if you've noticed the trend so far, is a lot of domestic buyers, as well as in the office space, it's funds who have money to deploy. And under that category, 522 Fifth Avenue, we did not put it in our office stats because technically it's an office condo. It was the above portion of the building that RFR bought from Morgan Stanley. Morgan Stanley has their wealth management division there headquartered. They're going to remain in the entire building for the next 3 years, and then they will vacate. This purchase was in the wake of RFR, previously backing out of the 900 Third Avenue in March, but now they are clearly back in acquisition mode after the Chrysler Building and several other transactions, and a lot of their money coming from Germany in a very low interest rate environment. No doubt that they are looking for well-positioned assets that deliver cash flow in this market. So now I'd like to talk a little bit about distress because I think this is a topic that a lot of you like to hear about, especially those of you looking to buy and where the opportunities are. And I know Justin is going to speak about this as well on the tail end of this, but we do a lot of work with the special servicers. And just looking at the pipeline that's happening here, in 2015, the servicers had under $1 billion. That's ramped up very quickly to about almost 20 billion just in the last 90 days. So there's 297 loans. This was as of the first half. I'm sure the number has increased substantially. Excuse me, it went from 297 loans to 1,800 loans in 90 days. And so a lot of this, as you'll see from the next slides, in hotel and retail. So hospitality in 2020 accounted for 70% of this distress, and then retail at 24.8%, and then the other asset classes in the low single digits there. So it's really, the distress that's been happening with the servicers so far has been, predominantly hospitality with a little retail, but would not surprise me if we start seeing certainly more, certainly the mixed use properties, retail, resi above. The lenders for the most part have been giving forbearance, but when that dries up and if some of these tenants do not return, I think you're going to see a lot more loan sales that are going to be happening next year. Now, if you look at the next slide, and I thought this would be interesting just so you can kind of see how New York stacks up, but if you look at all the special servicing right now, Texas has the most loans that are in distress out of the whole, but New York is second, and then Florida and California. So there are going to be a lot of opportunities here, I would say. So, those are the questions that we can get into on the panel and discuss, but, when will this distress hit? How is that going to affect pricing? My personal opinion, and if you read my white paper on the AY tristateinvestmentsales.com page, talks about the calm before the storm. And I think that pricing is going to get worse before it gets better. I think those selling right now, there's not a lot of competition out there. There's not a lot of products. So we're actually getting decent activity. But I think when we start seeing some of these distressed sales and some of this get flushed through the system, I think certainly, the pricing could drop further before rebounding. Of course, I always say this is asset specific. I'm really talking about retail. I would assume hotels. We're going to have a discussion next on office, and then we can draw our conclusions from that. But, industrial and essential services, medical, you can make the case that certainly has done better. I've heard of Amazon selling for 4 caps, and we're out in the market with some CVSs and City MDs and getting good response there. The next question I think is going to be covered by Keith Caggiano, as far as, when do we think people are going to start coming back to the city? Will they come back? And, what's the investor appetite going to be moving forward? So with that, I'd like to turn it over to Marisha to walk us through some of the office statistics for the third quarter.
Great, very good information, James. Thank you so much. We'll start with, typically I like to start with 3 key themes, and this year, as we know, they all relate around uncertainty, which has weighed very, very heavily on the Manhattan office leasing market. So we've seen uncertainty as it relates to COVID-19. A lot of the impacts surrounding COVID-19, there's one major one is that there's been ambiguity regarding the timing of an available and effective vaccine. Secondly, we have an upcoming election. There is uncertainty that casts doubt on a smooth road to an economic recovery and so much more. And all this has led to the reevaluation of office space requirements and a leasing environment that has definitely slowed. Next slide. So where are we with the stats and other key metrics, and where do we see things heading? As of the end of the third quarter, leasing volume ended up at 4.7 million square feet. This is down 45% year over year compared to 8.6 million square feet last year. And I do want to point out that when we look at leasing volume in terms of where it ended up after the start of COVID-19 at the end of the first quarter, it's down 36%. So the 4.7 million square feet compares to 7.3 million square feet. There were key top transactions in Midtown, such as the Facebook 730,000 square foot lease at the Farley building. There was also the BNP Paribas renewal at, that was 322,000 square feet at 787 7th Avenue. And a lot of this top activity offset record low leasing volume in downtown. So in terms of where we are with vacancy, we're at a record high of 12.7%. And that's right above the 11% equilibrium level. So it's very indicative of a highly, highly tenant favorable market. And as you can see, vacancy is at 12% or above equilibrium across all of the Manhattan office leasing markets. Regarding average asking rents, they came in at $78.90 a square foot for Manhattan overall, down 5%. Now, what I want to point out is that year to date, we are tracking at 15.6 million square feet of volume at the end of the third quarter. And this is down 43% when we look at the 27.4 million square feet that was executed for the same period last year. I do compare this to some of the other gateway markets, and the declines there range from 50 to 73% in a lot of the gateway cities on a year-to-date basis. And that's pretty much for Chicago, Boston, and San Francisco. So given where we are in the fourth quarter, right now, the largest transaction has only been 38,000 square feet, and closed deals have actually equated to just under 300,000 square feet. So again, we are tracking for leasing volume in the Manhattan office market to come in at a record low this year. And again, we're seeing this at across a lot of the gateway cities. Next slide. Election years always build uncertainty, and pretty much this year is no different. At the turn of the century, there's been, with every election year, volumes have declined. When we look at 2008, when leasing volume was the lowest, coming in at 25 million square feet, everything was exacerbated by the the housing bubble and the financial crisis, which led to the Great Recession. Looking at 2012, where we had the lowest volumes of 21% in terms of declines, we had the fiscal cliff as well as the Eurozone crisis. And then moving ahead, fast forward to 2020, naturally what we're seeing now is an election year with everything exacerbated by COVID-19 and a global pandemic. So overall, every year, it never fails, every presidential election year here in the US, there's always a negative impact on leasing volumes. Next slide. Given the overall competitive leasing environment, there's been a lot of companies that have been reevaluating their office space requirements. And as a result, as of the end of the third quarter, there's been about 17 million square feet worth of sublet space that has been added to the market. And much of this space has been added primarily by your TAMI tenants in Midtown at the market level, as well as in Chelsea in the financial district at the submarket level. And this is based on a 12.7% total vacancy rate. So when you look at that 17 million square feet of space added to the market, that equates to or represents 28.7% of all vacant space in the marketplace. And then when we start reaching that 29% level, that's when we in fact start to see pricing declines and a related impact in direct average asking rents, which is what we're starting to see. So if you go to the next slide, this just shows where pricing, and when I talk about pricing, I'm talking about direct average asking rents. It shows where pricing was first quarter, and then after the start of COVID-19, where we are second quarter, and declines have pretty much ranged in the 1 to 6% level. And this is pretty much consistent with what we're seeing across other gateway markets. The declines for some of the gateway markets were down by as much as 7%. So 2 to 7% for the other gateways as a comparison. But at the end of the day, we do expect more competitive sublet space to come on the market, and we do expect further declines. Next slide. Okay, so we talked about competitive sublet space being added to the market, added to supply. There's other additions to supply, such as new product deliveries that will take place. So looking at the demand side of the equation, the Manhattan office using employment, which is a lagging indicator, shows continued weakness in the near term. And as a result, what we do look at, we look at the Moody's economic forecast, and they're actually projecting a net loss of 41,000 jobs by the end of 2022. So when we add this to when we complement this or add this to what we're seeing on the supply side, the next slide, if you will, we actually come to our consensus that we do expect a 200 to 250 basis point increase in the vacancy rate. So going from 12.7% to approaching the 15% level by 2022. And in terms of average asking rents, when we look at where we are, well, actually we look at the last downturn as a gauge, and asking rents declined by 26% between 2007 and 2009. So when we use that same train of thought, even though we're in unprecedented times, average asking rents could decline by 20 to 30% by 2022. And again, this is just illustrative of where we see Midtown Class A product in terms of asking rents there. Next slide. So what are landlords doing, and what do tenants want? So given the varying levels of uncertainty and a leasing environment where tenants are slow to pull the trigger, unless they have to, landlords have been reaching to close deals. So at the onset of COVID, many landlords were holding rent steady and then ultimately sweetening the deal by way of increased concession packages, mostly in the form of free rent and less movement on the tenant improvement allowance side, but still lowering net effective rents nonetheless by an average of about 8%. So overall, what we are seeing now is that for a 10 to 20 year deal associated with a creditworthy tenant in Class A product, we have seen an average of 14 to 18 months free rent and TI in a range of $100 to $130 per square foot. And some landlords have actually cited their willingness to adjust pricing down by 10%. And at the end of the day, for the right creditworthy tenant, landlords are more willing to reach to seal a deal and are getting more creative. They're doing things such as paying architect fees and also including furniture in with the transactions. What do tenants want? What we're seeing is, first of all, when we look at the third quarter leasing activity, about 75% of the transactions were for requirements of 10,000 square feet or less. And regardless the size of tenant, no matter big or small, they all want the same thing. They all want short-term deals, 2 to 3 years in duration. They want to be incentivized. They're looking for pre-built and expensive space, not raw space, that's typically fully furnished. And they are seeking add-ons such as wiring, naming, and signing opportunities. Next slide. I'll just wrap up by talking about a few key trends that we expect to continue to play out in this environment. We expect vacancy rates to remain above the equilibrium level, so above that 11% across all of the Manhattan markets. And this is particularly true as more competitive sublet space is added onto the market. And then we're also monitoring the amount of direct space coming online as well. Uncertainty around work from home policies. What we're seeing now is about 10 to 20% of workers that have returned to a physical office building post Labor Day, and an uptick within this metric is expected to continue. But again, it's really industry specific, and Keith can speak to that shortly. I made reference to a few of some of the gateway cities and in terms of what we're seeing, but people still ask, is there a flight to the suburbs, as it relates to the office tenant? So although the majority of tenants wish to remain in Manhattan with easy access to a diverse pool of top talent, a large number of financial institutions are considering 3-year branch offices in the suburbs. And we have yet to see any meaningful financial services firms make any big shifts to the suburbs and execute on this hub and satellite strategy, but there have been a few small deals in Connecticut. So in conclusion, at the end of the day, it's all about healthy buildings, and landlords must strategically offer tenants space in a healthy building at the right price. And with that, I will turn it back over to James.
Perfect. Thank you so much, Marisha. And actually, if we can just go back to the last slide. So we're gonna now have a discussion with Keith, and we thank you again for setting the stage. And Keith, this is unscripted, unrehearsed. So I hope you weren't expecting slow pitch softball questions. So I've got to ask Keith, I mean, do you really believe, if only 10% of the workforce has returned, how are we saying that we think that vacancy is only going to rise from 12.7 to 15% by 2022? Because we got a lot of people listening to this webinar right now, and I got to think that they're believing the same thing. Is how do we think that the vacancy rate could only increase by a couple percentage points?
Thanks, James. So, to answer that question, you really have to look at the fundamental difference between residential and commercial real estate. Can't ignore the fact that prior to this year, the vast majority of, and I'm taking the sublet space out of the market for the moment to really focus on true vacancy, the vast majority of deals average somewhere between 10 and 15 years, and larger scale deals even to 20 years. We've had 6 years of eclipsed leasing activity dating back from 2014 all the way to 2019. So when we talk about two different things, we talk about a vacancy rate, you're talking about whether a tenant is occupying the space right now because only 10% of people have returned and call it a phase one return post Labor Day, versus how many people, and I know there was a question from the group about how many people will return and when over time. So the first is, what is the issue as it relates to Justin's discussion in terms of debt service? Well, a space that's not being occupied right now because of, elongated or prolonged COVID concerns, isn't at issue with most landlords. And I think the concept of, rent relief during this time has certainly died down. But if we're talking about an overall availability rate, which factors in the sublet space onto the market, I do support that thesis of there being an increase, but a gradual increase. And part of that goes to my overarching thesis about where we stand in the market right now. New York, by definition, and especially our industry, has very little hindsight and constantly is living in the now, and therefore doesn't have the foresight to draw strengths from past downturns. So this new normal concept, through, like, maybe I'm dating myself in terms of the market, this new normal concept we've seen time and time again dating back to the 90s. So the concept that we're entering a new normal where work from home is going to be, the standard and the norm, that's New York's, I would say, eagerness to take what is ever occurring now and extrapolate it out far into the future. Unlike past downturns and even the it's called post 9/11 or post Great Recession, I think we all can agree that this has an end date to it, right? Notwithstanding what occurs in the election, God willing, sooner than later, but there will be a vaccine, right? That is what has forced us into what I think most agree is a planned recession and into this work from home environment. So while I believe this trend has been elongated, I think when we all shut down in March and April, the thought was, okay, we'll shut down for a few months, the curve will flatten, and therefore we'll be back in the office in September. I think September has now morphed into January. And I think that those who were thinking January are now picking a date of June. And part of it is, I think it's just the comfort of selecting a date that people are going to return to the office. So, notwithstanding a wholesale breakdown in the equity markets and the overall economy, I just don't think this has a long-term effect on the market. I think that it is a profound effect on the market this year, and I think it'll still be filtering through the market next year. But as you go out numbers of years, it's really a bet against New York City, which has never paid in the last 25 years.
Okay, well, those are some fair points, but I'm going to continue to press. So
Sure.
What about Microsoft? What about Twitter? They're saying, hey, you don't have to come back to the office again. Google's already given their employees a year. Now, a lot of these other companies are following suit, but some of these companies have said, look, this is permanent now, that people will have that option to work remote. So how many of those companies are in that camp? And if that's the case, if employees are truly given the choice whether or not to show up to the office, how do we know they're going to come back?
It's an excellent question. It's definitely the question of the day. I think the premise that we are working from home, in my opinion, is a fallacy. We are all trying to work and be as productive as possible in most instances in a forced quarantine environment. And I think the most interesting metric, which no one has, is Dropbox was the most recent to announce that employees can work from home forever, right? And forever is always a dangerous term in any business. There is no metric to compare a trading firm, an investment bank, a tech firm, an advertising firm. There's no metric to compare the efficacy of a firm that's working 100 or 90% in the office, let's say, in terms of flexibility of hours or flexibility on Friday, which I think the overall economy has been moving towards for a number of years, versus a firm that's predominantly working from home. That metric doesn't exist. So companies coming out to say we're working from home forever. Now, again, a lot of the employees are coders. Could that have been a trend that's been accelerated by COVID? Certainly, in terms of office space. But until that metric exists, which probably won't be measured for the next year plus, where a financial services firm says we're predominantly working from home and one that's predominantly working from the office, and you can compare the P&L, the success ratio, the revenues, the earnings of those firms, no one knows the long-term efficacy of working from home.
Fair. Okay. So let's talk about deals that are actually getting done right now. So, and you've worked on the landlord and the tenant side. So how are landlords actually getting deals done right now? And then if you're advising a tenant right now, I mean, I see our one of the bullets that Marisha presented before was that most tenants are opting for 2 or 3 years. Now, Justin's going to tell us that's not very helpful in the financing department. So first, how are landlords getting done? How are they structuring leases differently now? And if you're repping a tenant now, how are you advising them?
Sure. So you're right. I work on both sides of the equation. When you're talking about prognostication over a long period of time, you delve into the practice of sort of guaranteeing or overpromising and under-delivering, which not only would I never do, but we never do as a firm. is I will tell you that on my side of the aisle in brokerage, I'm always very confident to talk about my view on the market 3, 6, or perhaps even 9 months into the future. And the reason for that is, as you articulated, James, the deals that you're seeing are all in the rearview mirror. In a way, they're yesterday's news. But right now, I'm negotiating tomorrow's comps. I'm conducting tomorrow's deals in terms of tour phase and seeing which buildings I'm confronting competition on. I'm having the meetings with tenants who have leases expiring or needs, whether they're going to dispose or place or expand their offices or relocate. So I will tell you that there's been a definitive uptick in activity post Labor Day. Tenants are of all sizes are touring, they are making decisions, and the fear that gripped the market in March, which was, I don't want to be the fool, for lack of a better word, that makes a deal amidst all this uncertainty, has now shifted to, okay, which we should be studies of history, if we think that this downturn and recovery will be slightly quicker than past, and we look at Lehman Day of September 2008, really when were the best deals cut? And a lot of tenants then did what some are doing now, which is the kick the can down the road philosophy of extending for 2 to 3 years. Well, in retrospect, we can look back at those deals and say, if you kick the can down the road from 2009, 10, and 11 to 3 or 4 years, you ran into the return upswing into the market. So the deals that are getting done now, and I'll answer the question about how they're being structured, the deals that are getting done now, I think that there will be a demonstrable uptick, not only in the fourth quarter, or surprising uptick in the fourth quarter and leading into the first quarter, just based on what I'm seeing. Now, the question is, it's October 15th, and are those deals going to close by year end, or will they bleed into 2021? But in the next 3 to 6 months, just based on what I'm seeing, boots on the ground today, tours are up, activities up, proposals are up. Tenants want to make decisions, and some of them are in rather high profile buildings. In terms of how landlords are structuring, I think that the biggest fear component in the market right now is the sublet space. Where is it? When is it coming? How is it going to be priced? The benefit or the strength that landlords have right now, which is how we're seeing deals get struck on a direct basis, is that unlike the last recession, or certainly post 9/11, we weren't living in a zero interest rate environment. So money is still cheap, and actually cheaper than it was during the last run up. I think that before COVID, we were seeing a retrenchment in TI packages from the 130, 140, 150 levels, or however you value a new building installation, lower than a 125 number. And we certainly saw compression on the free rent side. Face rents have been consistent, as we all know, based on the statistics for years. What we're seeing now is landlords willing and trying to hold on to those face rents for a myriad of reasons, but being willing to increase that TI, and certainly willing to increase that free rent, because if you're going to, and you and Justin and know this as well, if you're going to your lender, there's an acquisition of the building you're doing, you need to underwrite a significant amount of downtime just based on all the uncertainty. If that downtime can be converted to free rent in the context of a live body creditworthy tenant, well, landlords are taking advantage of that. And that's what we're seeing in the market right now. I do agree with Marisha. I think the market is down 10%. I think that there's definitely the biggest spread in bid ask that I'm seeing right now is on sublet space. I think brokers and tenants that are pursuing sublet space assume the tenant is in some element of distress, assuming they're long-term viable, and they're really trying to push the envelope there. So unless we see this explosion of sublet space, which many are anticipating, unless we see it, outside of this decreased demand, there really is no pressure for landlords to recalibrate pricing right now.
Thank you. So we have a quick comment and question, and I'm going to turn it over to Justin. And Terry Gamula, great hearing from you, and I always love to hear your comments. So Terry, her comment is that there are ways to monitor effectiveness, work from home. I mean, I can speak personally. I mean, we have our Salesforce stats. We know who's logging what calls, but I think the additional thing is of kind of what goes on in between those logged activities. Certainly on the sales side, it's very difficult to kind of understand how people are spending their time. I mean, if it's more of an analyst role where they have to produce a certain document, yes, we can see are they. So I think it really does depend on the role. But Terry's quick question to you, Keith, is are tenants, how important, I see Marisha's last slide was the healthy buildings. So, are they making sure that these buildings have the right filtration, the MERV 13, HEPA, is that something that's, a requirement now for tenants?
This for me, it's
Yes.
definitely something that we're seeing. Again, there's only so quickly that buildings can adapt these changes. So I think long term, health and wellness will be a priority in the same way that post 9/11. While just going back to my prior point, we all heard post 9/11 that downtown would never recover, and Bloomberg was pressuring Silverstein to take rents in the 40s, which we can all look back at now and laugh. That's what I meant by having no memory and no foresight. But in terms of the desirability of tenants, the one thing we are seeing now is tenants wanting full floors, whether that's certain tenants stretching a little bit to get to a full floor size, or smaller tenants, 5, 10, 15,000 feet, wanting to be on a full floor as opposed to being on a multi-tenanted floor. So that's the immediate reaction to the market, is that I believe boutique buildings, certainly newer buildings, there's been a lot of publicity around One Vanderbilt. I think that there was an announcement yesterday of deal closing there. I think you're going to start reading about a number of deals closing at One Vanderbilt. That would support Barry's theory that wellness is going to be here with us for a while. And I think that that's one of the examples of ventilation, air conditioning, air sources. But the immediate reaction is from tenants is a desire to be one of two tenants on the floor, or control a floor to themselves, just in order to maintain cleaning specifications as well as control their own HVAC system.
Perfect. Thank you. Okay, Justin, debt markets, what is going on out there?
So, good question. There's a lot going on. Actually, I wanted to touch back to a lot what Keith was speaking about on the office market, and I guess give two scenarios that I'm dealing with right now. We closed the deal in July. It was a $115 million loan on an office building. We got the client a 2-year bridge loan with two banks that we partnered up together. One of his larger tenants, which is only about 9% of his building, reached out to him. They're a co-working company. Won't say which one it is, but they said they're trying to renegotiate with him because they feel that, due to COVID and all the other scenarios, that this might be a good time to try to squeeze them a little bit. And, they're threatening to blow out of the building. He called me up and said, look, I have a backup co-working company that will actually pay more than what this group is currently paying. He had reached out, being a good borrower, reached out to his lender and said, hey, here's the scenario, because he's thinking 18 months down the road about his refinance, about doing a permanent refinance, 5 or 10-year type deal. How would those two banks look at a new co-working or just co-working in general? And they came back and told him, and hence why he picked up the phone, called me, that they will mark it as dark space and give him 0, even if he's getting $2.5 million a year in revenue on a permanent basis. So his question to me was, do all the lenders look at it that way? Or is it just these two banks and maybe on the bank side, but can you make some phone calls, Sunday, Monday, Tuesday to a couple insurance companies and life cos and see if it's the whole industry? And come to find out, so I spoke to the 4 insurance and life companies, and all 4 of them said that they will give him credit as long as, and each one is different, it's between 10 and 15% of the building. In his case, they only occupied 9%. So they would give him credit for that tenant being there. I found that a little bit interesting. So that's one scenario that we're dealing with. And I think it's going to happen a lot, especially with co-working being very popular over the past, couple of years in New York, not just in Manhattan, but in Brooklyn. And one other scenario was we are looking at a deal right now. The client came to us. There's 4 tenants in the building. One of the tenants took a larger amount of space, and Keith, you were starting to touch on it. This was because they plan to grow in the future, but they're not utilizing all that space. About a quarter of the space is, we'll call it dark, and not occupied, but they're paying for it. The client really wants a CMBS loan, and what the lenders are kind of pushing back and telling us, though that they're paying, they will not count that unused space. They'll mark it as dark space and give them a 0, even though there's revenue coming in, which I found kind of interesting. So that's one office. Those are like scenarios that have been coming up that people have to think about in the future, especially if you're buying an office building and you have a value add approach to it, and you're fixing it up, you're going to lease it up. Lenders are really, really scrutinizing the tenants in the building.
And Justin, does that apply to multifamily as well? Because even in these fair market buildings, I mean, I'm hearing vacancies now as high as 20%. And, the leases that are getting done are being accomplished with a lot of free rent. You hear 2-3 free months. So
Right.
Are these banks underwriting on the net effective rent? Are they, are the vacancy and credit losses, are they jacking up to 15-20%, or do they assume that the NOI is going to normalize? Are they looking at kind of the pre-COVID? How are they underwriting that cash flow?
It's very difficult right now, because the big pushback, especially for New York City, for Manhattan, for multifamily, is in maybe, like, for example, some walk-up buildings where typically it's been younger people, they get out of college through 30 years old. Are those people going to be in the city? Are they going to have jobs? Traditionally, you got somebody that's 25 to 30, they're in that, maybe they have some roommates, they move up in their career and they're moving out and they get married, or some other scenario where they're moving out of that type of apartment. And then there's a new batch of young people coming in, from graduating college, getting their first job, moving out of mom and dad's house. Well, because of COVID, those young people aren't getting hired, and they're still living in mom and dad's house in their bed or in their mom and dad's basement. Nobody knows when those people will be coming in, and will there be jobs for them? So that is a big concern, especially on some of the value add multifamily deals that we're seeing.
The good news, though, is that the rates are unbelievable.
Yes.
It's just, I mean, what you're talking about, what's really suffering here is the leverage. So if pre-COVID, if you would have told us on a multi-loan, you were 65, maybe 70% loan to value, again, if the bank is saying, hey, we're going to, use a higher vacancy and credit, we're going to be using net effective. Obviously, the NOI is down considerably. I mean, maybe you're only getting a 50% loan to value, but the good news again is that, the rates, and I've heard, the Fannie and Freddie, I'm hearing sub 3% now. So,
Yep. Yeah. I mean, we saw some quotes on some Fannie Freddie deals recently. I mean, it's a range and depends on the deal and depends on the leverage and all that good stuff. But, 2.4% to 3.1%. We've received quotes on different multifamily deals. I mean, it's not free money, but it's pretty darn cheap. And even if you're getting lower leverage, maybe you're putting some pref equity on it, which is a little more expensive, but it gets you up to the leverage that you need to be at to be able to acquire the asset, and you're still in at a really, really low rate, historically. Compared to a couple of years ago, we're talking about 5% rates. It's kind of nuts.
So if Fannie and Freddie are in that kind of mid-high 2 range, are the community banks just totally out of luck, or why would someone, look to go to a community bank as opposed to getting, a government-backed loan?
Well, I mean, traditionally in New York City, community banks have beat out Fannie and Freddie. A lot of times Fannie and Freddie, people go that route. Hey, it's cheap money, but you could also get higher leverage, right? 75, 80%. In New York City, a lot of times you're not going to get up to that 75, 80% using Fannie, Freddie because of, debt service coverage ratio, debt yield. There's many different factors. And, I remember having a meeting with the people at Greystone about a year and a half ago, and they said, we actually don't do a lot of Fannie Freddie agency deals in New York City just because the banks actually beat us out a lot of times. The issue with the banks that we're running into right now is they have a lot of issues that they have not addressed. Going back, not just COVID related, but James, you and I did a breakfast symposium right before last Thanksgiving with about 15 New York City lenders. And we asked them the question, like, have you guys marked the market? Any of the loans that you have on your books on the multifamily side, from when all the rent regulation and all the new laws came into effect last, the summer, a summer ago. And all of them at the time said, no, we just want to get through the end of the year. We will address it, come next June, July. And then COVID hit, right? So they were able to kick the can down the road. So a lot of these, these multifamily buyers have had forbearance agreements, and a lot of them have been able to pay. But once these banks have to mark to market their loans, which is going to happen soon, there's going to be a lot of people with issues, and they'll have to come up with some more capital to right size these loans because appraised values might have gone down 10 to 30% on a lot of these buildings. What's going to happen then? The banks are going to have to address it. The borrower obviously is going to have to address it, and that's why you have all these funds out there. Everybody calls and says they want non-performing loans, but I think the biggest play, especially on my side of the business, is coming in with what some people call it rescue capital, but some capital in the preferred equity position to kind of come in. Maybe you cram down the borrower, but you're right sizing the loan. You're getting the bank comfort that the loan's now not underwater, or getting the LTVs back in place. So I think that's a bigger opportunity, at least on my side, than everybody's saying, I want to buy a non-performing loan. Well, it's not there yet. So I mean, it's multifamily in New York City. It'll be very interesting to see what happens and how these banks address the issues.
Absolutely. So this has been a great conversation. We only have a couple minutes left, but Justin, I did want you to address this slide because I always like to go out on a positive. And what's amazing to me is the spread right now between the 10-year Treasury. And I know you do a lot of lending off of LIBOR, but still, I mean, if you look at where cap rates are in relationship to where you can borrow, I mean, you're seeing a 400 to 500 point spread here, where go back to the days of 2007 when office buildings, those cap rates were less than the 10-year Treasury, and even like 2008, 2009, when those were some of the best buying years in history, there was only a 200 basis point spread there. So like this is a moment in time I have not seen in my entire career. I don't know if you have, but we were running some numbers with our, we have our bi-monthly associate director breakfast. And, we were calculating cash on cash returns for some of our, income producing deals in the double digits. I've never seen that in New York before. So I've got to think that this is an opportunity here to lock in long-term debt.
Yeah, no, obviously the chart speaks for itself. In New York City, prices have been beaten down, between your stuff and Marisha that you guys showed. It's very obvious. I think now, look, some people run towards the fire, some people run away from it, right? But New York City, as Keith said, tends to always come back. And now's the time to, frankly, not to give you a sales pitch, but for people to call James and his team and see what they have and start buying. I mean, I'll put it this way, even I think, James, you sold a property a year and a half ago on the east side at like a 2.7 cap. Getting financing now for that might have increased their returns. So I mean, it's a good time to start looking to buy. I think a lot of people after Labor Day, as I said, the COVID vacations are I feel are kind of over. Kids are somewhat back in school, and a lot of people are sitting on cash that they haven't spent all year. And it's coming to the end of the year. Some of these funds might, use it or lose it, as they say. So I'm hoping that the fourth quarter, there's a lot more acquisitions. Obviously, rates are super cheap, not just on the perm, but on bridge debt. And I think it's a great buying opportunity.
Yeah. Yeah, the last thing I will say, and I mean, we saw and here, and thank you to Real Capital Analytics for this data here, but their New York City average cap rate was 4.57, which is actually higher than San Diego, Seattle, LA, and San Fran. And as you saw in the third quarter, Manhattan, we hit 5 caps on average. And whether it's Nashville or Austin or all these other growth markets that buyers have been chasing. And I saw this even before COVID. I was down at the National Multifamily Housing Conference, and all of our brokerage teams in Seattle and Nashville, and they had buyers lining up around the corner to try to buy 4 caps, and here we had north of 5s in New York, and now these 5 caps are predicated on lower rents. So you have that double whammy effect where there's some incredible value here. So I would certainly urge you all to look at these new listings coming out. Again, I referred earlier about the 20 new listings. I mean, we're having real conversations with our clients now and saying, look, this is where the market is and we can transact. And so I am, it's not going to take much to boost the sales activity from the second and third quarter, but I think we're in for a very strong fourth quarter. And next year, I think when some of this distress starts to hit, that sales volume will even increase. So, hopefully, and whether it's a V or a U, I think it will take some time, but hopefully the worst from at least a sales perspective is behind us. So I want to thank you all for joining, Marisha, for all the great stats and work that you do, Keith. Incredible commentary, and Justin, thank you for telling us where the debt markets are, and thank you all for joining.
Thank you.
Thank you.